Somewhere in a government building, a small group of people can look at a number on a screen, type a few characters, and hit enter. And in that instant, billions of dollars exist that did not exist 5 seconds earlier. No gold moved, no vault opened, no one worked an extra shift to earn it. It just appears. And here is the part that should bother you. That money is now worth exactly as much as the money you spent your whole week working for. Same dollar, same weight in your wallet. One of them took 40 hours of your life. The other took 4 seconds and a keyboard. That is the trick at the center of the entire global economy. And once you understand how it actually works, you will never look at a dollar bill the same way again. This is money printing, explained the way no one ever bothered to explain it to you. Let's start with why this matters right now, today, not in some abstract textbook sense. In the last 20 years, the amount of US dollars in existence has grown faster than almost any other period in modern history. In 2008, there were roughly $850 billion in circulation as base money. By 2022, that number had exploded past $5 trillion. That's not a typo. That's a 6-fold increase in a little over a decade. And it didn't stop there. Add in the pandemic years, and trillions more were created in months, not years. You felt this. Even if nobody explained the mechanism to you, you felt it. Your grocery bill felt heavier. Rent felt like it was chasing you. A house that used to feel reachable started to feel like a joke. People kept asking why prices were rising, executives blamed supply chains, politicians blamed each other, but almost nobody said the sentence that actually explains most of it. There is simply more money chasing the same amount of stuff. That sentence is boring. It sounds like a Wikipedia line, but sit with it for a second because it is the single most consequential idea in modern economics, and almost nobody outside of finance actually understands how it happens mechanically. So let's build it from scratch. No jargon, no lecture, just the actual machine. Imagine a tiny island economy. 10 people live on it. Between them, there are exactly $100 in circulation. A fisherman sells fish, a baker sells bread, a carpenter builds furniture. Prices settle into a rhythm because everyone roughly knows how much money exists and how much stuff exists. One day, a stranger rows onto the island with a suitcase. Inside the suitcase is another $100. He didn't earn it by fishing or building or baking. He just had it, freshly made, and now he's spending it on the island. Nothing on the island changed. Same number of fish, same number of loaves of bread, same number of chairs. But now there are $200 chasing the same amount of stuff that $100 used to chase. What happens to prices? They rise. Not because the fisherman got greedy, not because the baker suddenly decided to charge more for fun. Prices rise because money became more available while goods did not. This is the entire concept, condensed into one boat and one suitcase. Now scale that story up to the size of a country with 330 million people and an economy worth over $25 trillion, and you have the real machine. Here's how the real one physically works. A central bank in the US, it's the Federal Reserve, does not print stacks of $100 bills to hand out. That's the cartoon version. Physical cash is actually a small fraction of the money supply, something like 10% or less. Most money is digital. It's created the same way that suitcase appeared on the island, except instead of a boat, it's a keystroke. Here's the step-by-step. The central bank wants more money circulating in the economy, so it buys financial assets, usually government bonds, from banks. To pay for those bonds, it doesn't pull money from some giant vault. It creates new digital reserves and credits them to the bank's account. That money did not exist 30 seconds before the trade. Now it does. The bank now has more reserves sitting with the central bank, and banks don't like reserves sitting idle. They want to lend, so they extend more loans, more credit, more mortgages, more business loans. And here's the twist most people never learn in school. When a bank issues a loan, it isn't handing you money that was sitting in a vault from someone else's deposit. It's creating a new deposit in your account, out of nothing, backed only by your promise to pay it back with interest. That's right, most of the money in the modern economy was never printed by a government printing press. It was created by banks as debt the moment someone signed a loan agreement. Roughly 90% of the money supply in most developed economies exists this way. not paper, not coins. Debt, converted into numbers on a screen. Let that sit for a second because it means something. Uncomfortable. The dollars in your bank account, in aggregate, mostly exist because someone, somewhere, is in debt. If everyone in the country paid off every loan simultaneously, most of the money supply would vanish. Not metaphorically, literally cease to exist, the same way it was conjured into existence. This is not a conspiracy theory. This is not a fringe idea from an internet forum. This is standard central banking mechanics described in the Bank of England's own quarterly bulletin in 2014, which openly stated that commercial banks create money whenever they extend credit, and that this reality contradicts the common assumption that banks simply lend out existing deposits. The people who run the system have told you exactly how it works. Almost nobody reads the fine print, so now you understand the mechanism. Let's look at the uncomfortable math, because this is where the story stops being interesting and starts being personal. If more money is created faster than the economy actually produces more goods and services, the value of every existing dollar gets diluted. This is inflation, not the version where a shopkeeper is being greedy. The version where the currency itself is quietly losing weight. Here's a number that should genuinely unsettle you. According to the U.S. Bureau of Labor Statistics, a dollar in the year 2000 has the purchasing power of roughly $1.79 today, meaning what cost $1 in 2000 costs almost double now. Now here's the part almost nobody says out loud. That erosion isn't random. It isn't the weather. It is, in large part, a direct consequence of decisions made in rooms you were never invited into. Money creation acts like a hidden tax. It doesn't show up on your paycheck stub. Nobody sends you a bill labeled currency dilution, but every dollar you hold slowly loses purchasing power while the new money gets spent into the economy first by whoever's closest to the source. This has a name in economics. It's called the Cantillon effect, named after an 18th century economist who noticed something simple but brutal. When new money enters an economy, it doesn't arrive everywhere at once equally. It arrives first to specific people, banks, large institutions, asset holders, and they get to spend it while prices are still low. By the time that new money trickles down to regular wages, prices have already adjusted upward. The people closest to the money spigot benefit. The people furthest away absorb the cost. This is not a partisan statement. This is not a left-wing or right-wing framing. Economists across the political spectrum acknowledge the mechanism exists. They just disagree on how big the effect is and what to do about it. But look at the pattern with fresh eyes. Since 1980, asset prices, stocks, real estate have grown dramatically faster than wages. The S&P 500 has returned an average of roughly 10% a year over long stretches. Median wage growth, adjusted for inflation, has crawled forward at a fraction of that pace. If you owned assets when the money was created, you rode the wave. If you were earning a paycheck and saving cash, you were quietly standing still while the ground moved under you. Now let's contrast the hype with the reality, because there is a story people love to tell about money printing, and it is not the full picture. The hype version goes like this. Printing money stimulates the economy, saves jobs, prevents collapse, and the central bank are the responsible adults keeping the system stable during crises. And here's the uncomfortable truth. That story isn't false, it's just incomplete. During the 2008 financial crisis, the Federal Reserve's balance sheet exploded from around $800 billion to over $4 trillion through a program officially called quantitative easing. This did, by most economist accounts, help prevent a total banking collapse. It kept credit flowing. It arguably saved millions of jobs in the short term. Same story again in 2020. The Fed's balance sheet ballooned past $8 trillion in response to the pandemic. Emergency measures kept businesses alive, kept paychecks flowing, kept the entire system from seizing up during a genuine once-in-a-century shock. So the intervention isn't purely villainous. It's a tool, and like most powerful tools, it can save you or it can quietly bleed you, depending on how it's used and for how long. The problem isn't that the tool exists. The problem is what happens when the tool becomes the default answer to every problem, used so often that the side effects stop being treated as side effects and start being treated as just how the economy works now. Because here's the thing, nobody wants to say on a stage in front of cameras. Every time this lever gets pulled, it becomes politically easier to pull it again next time. Nobody loses an election for printing money to fix a crisis. Politicians lose elections for saying the harder thing, that maybe spending has to slow down, that maybe some pain now prevents worse pain later. So the pattern repeats. Crisis, print, relief, repeat. And each cycle, the baseline amount of money in the system ratchets higher, and it almost never ratchets back down. Let's zoom out, because this is where the story stops being about interest rates and starts being about something bigger. Throughout history, when governments have relied heavily and repeatedly on money creation to solve their problems, the pattern tends to end badly. Weimar Germany in the early 1920s, Zimbabwe in the 2000s, Venezuela in the 2010s. Different countries, different decades, different political systems, but the same underlying mechanism taken to its logical extreme. Now, to be fair, the US dollar is not Zimbabwe's currency. The dollar is the world's reserve currency, backed by the largest economy on Earth, the deepest capital markets, and a level of global trust that took 80 years to build. That trust gives the US enormous room to create money without immediate consequences that smaller economies would face instantly. But room is not infinite. Trust is not permanent. And there's a quieter risk brewing beneath the surface that gets far less attention than it deserves. Central banks around the world have been steadily increasing their gold reserves and, more recently, diversifying away from dollar-denominated assets. The dollar's share of global foreign currency reserves has slowly declined over the past 2 decades, from around 71% in 1999 to closer to 58% by recent counts, according to IMF data. Still dominant, still the biggest player by far. But the trend line is not flat, and trend lines that move in one direction for 2 decades tend to matter. This is the actual risk, not a sudden collapse. A slow erosion of trust, decade by decade, where the world's willingness to hold dollars quietly declines, and the country that has enjoyed the unique privilege of printing the world's reserve currency slowly loses some of that privilege. And here's the part that should really sit with you. Every single person alive today has built their entire financial life, their savings, their retirement plan, their sense of what a dollar is worth, on top of a system whose core mechanic, creating money from nothing to solve short-term problems, has never once in human history been used indefinitely without eventually producing a reckoning. Not a guaranteed collapse, not a countdown clock, just a pattern, repeated across centuries and continents, that should make anyone paying attention slightly more careful about assuming the current arrangement is permanent. So where does that leave you? It leaves you holding a currency whose value is not fixed, was never fixed, and is quietly managed by decisions you don't vote on directly and mostly never see. It leaves you understanding that when someone says the economy needs stimulus, there is always a second sentence that goes unsaid. Someone, somewhere, ends up absorbing the cost of that stimulus, and it is rarely the person who approved it. None of this means panic. None of this means the system is about to collapse next week or next year. Systems this large, built on this much trust and this much infrastructure, tend to bend long before they break. And they've been bending, adapting, absorbing shocks for decades. But understanding the mechanism changes something in you. You stop asking why prices went up as if it's a mystery. You start asking who benefited from the money being created and who was standing furthest from the spigot when it happened. Every generation has been told the same reassurance. The people in charge know what they're doing. The system is stable. This time is different. Maybe it is different this time. Or maybe the printer just keeps running quietly in the background of your life, redefining the value of every hour you've ever worked, while almost nobody stops to ask the only question that actually matters. If money can be created out of nothing whenever it's convenient, what exactly is it that you've been working so hard for?